Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, we have to start with just the extraordinary dislocation we saw in late December 2025. It followed what was, by all accounts, one of the biggest achievements in recent satellite history. ASTS, Space Mobile, they successfully launch and deploy Bluebird 6. This is the first Block 2 satellite, which, it technically validates their entire architecture. And yet the stock had this incredibly violent reversal.
That reversal is exactly why this is such an important moment to analyze, because the market at first, it responded with just, euphoria. We all watched ASTS climb. It briefly touched an intraday high around 92.95 right after they confirmed orbital injection. But then, on really high volume, a massive 26.2 million shares on Christmas Eve of all days, the stock just reversed hard. It closed down almost 9% at 78.05.
So the central question is pretty stark, right? Does that volatility, does it reflect structural market mechanics, a temporary supply shock hitting thin holiday liquidity? Or was this a necessary, irrational, fundamental repricing, one that's driven by extreme execution risk and, frankly, an unsustainable valuation? I'm going to argue this was all an isolated structural anomaly. The long-term tech thesis is completely intact.
And I'm going to maintain that the structural event, the selling pressure, it merely provided the catalyst that the market needed for a rational repricing. The market used that liquidity break to kind of step back from these really unrealistic expectations. I think the friction we saw, it shines a light on the huge gap between successful physics and successful, industrial scale business.
Well, let's start with the technical success, because that has to be the bedrock of the entire bullish case. The engineering here with Bluebird 6, it just can't be overstated. They put a 2,400 square foot phased array antenna into low Earth orbit. That's about the size of a small house. And they confirmed it can hit data rates up to 120 megabits per second directly to a normal phone. This event, it de-risks the entire technological premise. So the correction we saw, it wasn't a rejection of that achievement. It was a direct consequence of a massive liquidity break. We saw American Tower Corporation, Tower Corp, sell off about 2.28 million shares. That's a $159 million supply shock that it overwhelmed the order book that day.
I agree that the deployment was a success. A 2,400 square foot array confirms the physics. It confirms the audacious vision of the CEO. But look, it doesn't matter how beautiful the physics is. We have to look at the financial architecture that's supposed to support it. The market skepticism is completely rational when you see the valuation. A market cap of around $24 billion. Built on what? About $4.9 million in trailing 12-month revenue. That $159 million sale, it just gave the market an immediate chance to rethink that valuation. The core risk has definitively shifted. We are past the can they build it phase. The question is now, can they rapidly scale it? And that means building 60 satellites and hitting this incredibly aggressive launch cadence, one mission every 45 days through 2026, without, constant massive dilution.
I see why you think that the sale implies suspicion, but let me give you a different perspective. I think you're misinterpreting the signal from American Tower. While that massive institutional exit certainly hit the market, calling it a vote of no confidence is it's just too simplistic. American Tower is a REIT, a real estate investment trust. Their fiduciary duty is totally different. Their investment in ASTS was a strategic hedge, and a highly successful one at that. So monetizing a $159 million gain to reallocate capital to their core business or to service debt, that is a logical, prudent move for a REIT. It's just capital management. It wasn't a rejection of the future. It was just thesis drift. They were never going to hold that position forever.
I'm sorry, but I just don't buy that fiduciary excuse. Let me tell you why. That's a strong argument for their internal finances, but you're missing the market signaling. The optical impact was devastating. You have a strategic partner liquidating over 90% of its holding just days after the core technology is confirmed. That creates a profound crisis of confidence. It tells the street that the so-called smart money thinks the stock has topped out, no matter how successful the deployment was. And let's not ignore the compounded effect. This was happening at the same time as smaller but still significant sales from insiders like Shanti Gupta and Yao Huiwen. So the market saw this massive institutional floor just get pulled out from under it, and it reacted. The price discovery was violent because conviction from key early investors was just gone at that price.
Okay, but if we look deeper into the actual trading flows, there are signs that high conviction demand was there. It was absorbing that supply. We saw this extraordinarily high dark pool short volume ratio on December 22nd, something like 45%. Now, a lot of people see that and they panic. They assume it's massive bearish betting. But often, that high short volume is just aggressive market maker facilitation. When American Tower dumped those shares, institutions that wanted to buy the dip needed them instantly. So market makers, they often have to short internally in the dark pool to satisfy that demand. High off exchange shorting here, I think it suggests strong institutional buying that was soaking up that supply shock.
That's an interesting point, though I would frame it differently. I agree on the mechanics of facilitation, but I think the overall vulnerability is what's key. Despite whatever short-term buying happened, the total reported short interest is still critically high. It's between 22 and 29% of the float. That's, 32 to 42 million shares short? And crucially, that translates to 3 to 4.6 days to cover. So a high number like 4.6 means that if ASTS had stunning news, the shorts would be forced into a panic buy for days. But the reverse is also true. This high short ratio means the company is exceptionally vulnerable. If that 2026 deployment falters, if they miss that 45-day cadence, those short sellers are going to feel very emboldened to press the stock down towards support, maybe $60, $65.
And the spike to almost $93, only to close near $78. That was just profoundly exacerbated by the market's microstructure that day. It was a half-day session, extremely thin liquidity. This was classic event-driven profit-taking hitting a wall of, nothing. Speculative traders, they bought ahead of the launch, and they bailed immediately to lock in gains. With most institutional desks empty for Christmas, there were simply fewer big buyers to absorb that selling. It's not a signal of fundamental failure. It's a failure of the plumbing on a low-volume day.
I come at it from a different way. That shooting star candle at $93, that signals institutional exhaustion. A rejection of that price level, holiday or not. The market was communicating that $93 priced ASTS for absolute flawless perfection. It implies, 2026 revenues of over $1 billion? I mean, that's a staggering forecast. That valuation is built entirely on the perfect execution of a 45 to 60 satellite roadmap. And given how common delays and failures are in aerospace, that price was just fundamentally unsustainable. The sell-off back to the mid-70s, that's the market acknowledging the tech success, but baking in a heavy discount for the execution risk that is now front and center.
We should also address the persistent retail fear about a reverse split. It was everywhere during the volatility, and it's frankly an unnecessary distraction. ASTS has never done one. It's nowhere near the NASDAQ delisting range, trading in the $77 to $85 range. The confusion comes from the company's SPAC history with warrant redemptions. That process has complex adjustments that people just mistakenly equate with a reverse split. So we really have to be clear about the foundational stability of the share structure.
I agree the reverse split fear is a misunderstanding, but I'm not convinced by that line of reasoning because it lets us ignore the real capital structure risk, which is dilution. ASTS's capital needs are massive, and they're accelerating. To fund that 2026 launch manifest, they're projecting a 300% increase in CapEx. The market correctly sees the overhang from at-the-market offerings from ATMs.
An ATM offering is a program where a company can sell new shares directly into the open market, bit by bit, as the stock rallies, and ASTS uses this to raise cash. The problem is, every single rally, every time the stock hits $85, $90, the corporate treasury is probably using that moment to issue new stock and raise cash for the next launch. So this acts as a persistent natural price ceiling on the stock. New supply is constantly being added at higher prices, and that caps the momentum. The market isn't worried about consolidation, it's worried about the supply increase needed to fund 2026.
So to summarize my view, the volatility we saw in December was an isolated, if dramatic, incident of market friction. You had a $159 million whale dump from a specific kind of holder, American Tower, and it crashed directly into the thin liquidity of a holiday session. It temporarily dislocated the stock from what is an undeniable technical success. Bluebird 6 proves the long-term viability of a global telecom utility. The structural pressure will pass, the technical progress remains.
And I will absolutely acknowledge the engineering triumph of that 2,400 square foot array. However, the $78 price point reflects a critical and I think healthy market skepticism. A $24 billion valuation demands that a company execute a historically aggressive scaling cadence in 2026. A satellite launch every 45 days. It's a high-wire act, and it's burdened by huge capital needs and the constant risk of dilution. The friction we saw just illuminated the necessary reality check on what is still a very high-risk, high-reward binary bet.
And I think understanding this collision between the proven technology and the messy mechanics of the market is crucial for appreciating the complexity here.
It really forces any serious investor to weigh whether those temporary structural factors or this monumental fundamental scaling risk will be what dictates the trajectory in the high-stakes execution year of 2026.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.